Hi, everyone. This is Jason Bierko of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I'm really excited to speak to him. He has an amazing track record. He entered Wall Street in the mid-1980s with neither formal education or training, and in only 3 years, he was appointed head of investment strategy for a leading New York Stock Exchange member firm. He would go on to hold positions as Chief Market Strategist, portfolio manager for 4 hedge funds, a mutual fund that bore his name. He's been on TV everywhere. His book is really interesting, Confessions of a Wall St Whiz Kid. Hopefully it comes out on audiobook soon. It's got some amazing stories about all the shenanigans going on Wall Street, similar to the Wolf of Wall Street, Jordan Belfort. It was a crazy time back then. Peter Grandich, thank you for joining me again.
Well, it's always a pleasure to speak to you, Jason.
So, Peter, we're recording this interview on Monday, January 29th, 2024. The dollar index is at 103.41. Shockingly, gold's having a bit of a rally in dollar gold prices. We're up to 2033. Silver's holding okay at 23.17. I want to get your thoughts, though, on the bond bear market. Do you think that this is the worst bond bear market in history?
Well, it's been certainly within the 40 years I've been, because basically interest rates when I entered were 18%. And then a couple of years ago, they were down to 1 or 2%. So it was very hard, unless you played the corporate side, to lose money in the bond market. But what I think was really, really just blew my mind, I even made a short video about it today. And it reflects on my overall opinion that the stock and bonds rally late this afternoon because the federal government announced that instead of having to borrow 816 billion for the next 3 months, they only, and I underline sarcastically, only have to borrow 760 billion. And therefore the market said less borrowing is bullish for stocks and bonds. And that was for 3 months. And I tried to say it to somebody late today. If you put that over 4 quarters, that's over a $3 trillion budget deficit. Deficit, not debt. And it's the attitude and the laxated and carefree party like it's 1929 attitude that currently exists on Wall Street, with the absolute, no doubt about it, Jason, worst set of fundamentals in my 40-year career. From the usual debt, to the retirement and aging crisis, to the immigration invasion, to the BRIC nations going to basically eliminating the United States out of being a trading partner, and total political paralysis, which you're going to hope is going to be useful to solve many of the problems we have. And instead, not only do 2 parties can't enter the same room and make any type of decent legislation, but now each party has fractions within its own party that's not happy with it. So when you ask me about bonds and all that type of stuff, and I look at a market rallying because we're borrowing 50 billion less and only 750 billion dollars, the insanity of that and the absolute lax, carefree attitude by what I coined the "don't worry, be happy" crowd, which is most of the talking heads on Wall Street and the financial networks and medias that cover them, is just setting us up for what I have stated at the beginning of this year, that within 3 to 5 years, we will experience an economic, social, and political upheaval, the worst ever, and probably could end up as bad to make it the Great Depression a walk in the park compared to what we're going to have to deal with during this period. And let me just quickly say, it's not a period that I'm looking to see anything solved in months or even years. It's going to take decades.
And the national debt is growing at about $1 trillion every 100 days at the current pace. I don't know if it's going to be cut. I mean, the example that you just mentioned, the less amount of bonds sold, it's not slowing down that number. The debt is still growing at the interest payments on the debt. There's a lot of that older debt, that 34 trillion plus, is going to be refinanced at higher rates, Peter.
So the Congressional Budget Office in early 2023, really the last bastion of bipartisanship left in Washington, issued an alert at that time, when we were just a little over approaching 31 trillion, that its forecast was that we were going to hit 50 trillion in less than 10 years. And then, because we've seen just a dramatic increase in this deficit spending, we're at 34 trillion now. They have talked now as little as 7 to 8 years. Most people listening to this, God willing, are going to be alive when that time period comes. If we're at $50 trillion and interest rates are only on average 5%, historically, that's not high. That's a 2.5 trillion interest expense on a government that only last year managed to take in a little over $5 trillion. It's over. It can't, we won't be able to function in the manner that most people grown accustomed to or will expect going forward.
So the highest expense then for the government budget then would just be interest payments on the debt if we hit that scenario. So if we get to 50 trillion, I don't know, in under a decade, then the highest expense for the government wouldn't be the military, wouldn't be government employees, wouldn't be Medicare, Medicaid, Social Security, any of that. It would just be interest payments on the debt then.
Yeah, and that would be about half. Listen, we're probably going to see an increase in revenue. That's got to be expected, but it's not going to be anything remotely close to the increase in the interest expense rising. And this comes at a time when now states, the government, federal government's already talked about it. Now 5 different states, in fact, Vermont is moving very aggressively to implement what they call a wealth tax. But part of that wealth tax, forget about taxing the very, very wealthy. They want to tax unrealized capital gains. That's an impossibility. How do you say to someone who currently, you and I buy a stock here in January, and it's at $1 to make it easy. We buy 10,000 shares. And next December 30th, it's $2 a share. Now we have a decision to make. The government is going to expect us now to pay a tax on the unrealized 10,000 gain. But what happens if it goes back to 1 the following year? We paid a tax on something we never ended up really making a gain on. It's an imbecile. It's like, I try to put it in somebody's simple terms today, Jason. I says, it's like they're asking you to go to the racetrack, and if your horse is leading, to pay the tax on it winning, even though it still has halfway to go to the finish line. It's just, but those are the things the government is going to have to resort to, because remember, it can only do 2 things. It can cut taxes, raise taxes, which is one thing, or it can cut or increase services. Well, we're going to see a dramatic cut in services, and we're going to see a dramatic increase in taxes. And Jason, I don't sell or be involved in anything that's going to profit from this. My livelihood still remains in a planning group, and I can tell you, 9 out of 10 of Americans don't want to hear this. Even the ones that say to you, Peter, I know you're right. I'm just praying you're wrong.
Yeah, hopium is not an investment strategy especially for retirement.
It's a wonderful spiritual strategy, but it's the single worst investment strategy just to hope something's going to work out. And let me tell you this, right now, the professional community is, to me, the least intelligent since I've been in the business. I meet too many financial advisors who don't really have an understanding about finance. For instance, if you went and asked anywhere in parts of the United States and asked them what the largest single U.S. asset is, almost none of them will give you the correct answer, which is student loans. On the American books right now, on the United States books, on the asset side, is the largest single holding is student loans, what it has outstanding. Well, we have a government that's decided that it's going to allow certain people that have those loans to just walk away from them. Now, I'll tell you how I'm in trouble for a couple of reasons on that. First of all, I'm in trouble for somebody that paid for his kid to go through college, okay? And all the people that did take loans and paid them back, now we have parties who didn't get ripped off. They went through the same kind of interest rate all the rest of us went through. They got their education, or they had the opportunity to get the education if they so choose. But now they claim they can't operate because it's too much of a burden for them. Well, by the way, when you forgive that, that's lost tax revenue. The government has to come up with it somewhere. So it's going to actually raise taxes elsewhere. So I'm going to pay twice for doing the right thing. And here's the issue. Where does it stop? Do we get to the point where we say, well, certain people's mortgages, car loans, consumer debts, where does it end? We opened a Pandora's box here at a time when the government can ill afford. Listen, we still have to come up with, and the estimate is mind-boggling. Some estimate is 50 trillion. I've heard 70 trillion. but we have entitlements that people are expecting to be paid over the next several years of Social Security, Medicare, and Medicaid that we don't have any money sitting somewhere that's taken and paid for that. It's going to have to be borrowed in order to do that. And so I just see just so much trouble, and I see so little from the professional community. And let me give you one point other, Jason, that's critical. I speak of a retirement crisis and an aging crisis. 65% of Americans are working paycheck to paycheck. They are not going to be in any position to live out those wonderful commercials that the financial service firm runs, that if you simply go with them, you have this wonderful lifestyle into your retirement. We're also going to have an aging crisis when the taxation becomes acute and the young man or woman working at 30, 35, seeing the tax rate going up real high and seeing 80 and 85-year-olds getting all sorts of payments to medical procedures that they feel are unnecessary at that point because it's so costly, there's going to be a battle of the ages. But what about all the immigrants that are coming in? And I'm not going to start here about how many could be, terrorists, how many could be this. One thing we know, everybody that's basically coming in is basically coming in with their shirts on their back. They're not coming here and then transferring a bunch of assets over or able to start businesses tomorrow and be productive. They are going to be heavily reliant for quite a bit of time on government support. And all of these things come at a cost to those of us who are still pulling the wagon as more and more people are getting in the wagon. And we're going to get to the point that even where we try to not take our responsibility of pulling the wagon or try to get in the wagon ourselves.
The math just doesn't work for a lot of these things. I mean, the politicians, Biden and many others, they're promising all these extra government spending stuff just to buy votes. So they're promising either bailouts or they're promising these subsidies. President George W. Bush, I think he was Medicare Part D. It wasn't funded. Democrats and Republicans both do similar games to this, unfortunately. But I just saw a Wall Street article, Peter, saying that the national debt doesn't matter. It doesn't matter to the stock market, doesn't matter to investors. And I'm just thinking, well, I mean, like there's going to be a lot of inflation in the future because the government's not going to cut back. And historically, there's going to be more currency debasement. I think there's been a lot of currency debasement the last couple decades, and it's accelerated even the last couple years that the government hasn't publicly, they won't admit. So I think the amount of stagflation taxes that's already in the system, I think it's only going to get worse.
Well, two things. One, on the immigration, I'm convinced, I'm not saying this is right or wrong, it's just my opinion, that the reason that the Democrats as a group continue to welcome and do everything they can to keep them completely open borders is because historically, illegal immigrants, once they get here and they become legal, or at least allowed to vote, 90% of them have voted Democratic. This is strictly a power grab, without any concerns of all the other ramifications that come with that. But an interesting thing that you pointed out, another thing that the Wall Street financial service industry is just scoffing at, that's just going to come back to bite them so hard, and that is laughing, literally. I've had been on panels where the Main Street people literally laughed at what I'm about to say, and that is that the BRIC nations that are being formed now, within 3 to 5 years, are going to be such at a point of ability to trade and the amount of trading they're doing that it will have an input on overall world trade, the same thing that the Industrial Revolution brought to world trade. And no one seems to recognize that as that happens, it's not the United States being worked out of the program, it's being left out of the program. So all those countries that might have or in the past traded with us will look not to, and they're also going to look to eventually, as they are already now, not use the dollar. And if that's the case, and the dollar gets less and less usage, all those dollars still exist, Jason. They're going to come back to our shores, and that's just going to add to the inflationary scenario that you painted. So when people ask me, okay, well, Peter, what's the outcome of all this dire situation? It's not going to be like a depression where it was heavily deflation. It's going to be highly inflationary. It's going to be like what we saw the third world nations in the 60s and 70s, and still today still see countries where inflation, is 30, 50% or more. That's going to be the outcome of this. And as each week and month goes by that we don't do anything to start putting at least a top to all of this is just going to get worse and worse.
Well, I think DC doesn't carry their political party. No one at the top of the leadership positions is talking about spending cuts. I mean, they're talking about spending more, maybe taxing more. And then meanwhile, like you said, the foreigners, the foreign governments, especially outside the G7 post Russia sanctions in 2022, they're not buying the net treasuries. So China, Germany, Japan, I don't see them buying. And those were the countries that bought a lot of treasuries the last couple decades. I don't see them buying a lot of treasuries going forward. Same thing with a lot of these other non G7 countries. And I think that explains why, in addition to the size of the budget deficits, that we have the 10-year U.S. Treasury yields and the other yields, they're spiking like crazy. Have you looked at a chart of the 6-month chart of the 10-year U.S. Treasury yield? It's a roller coaster.
Yeah, I think the other mistake that the soft landing people talk about, 2% again, 2% 10-year, 2% inflation. That's the biggest joke of all. Neither will be seen again, in my opinion. Uh, I would argue that it will sooner be 6% interest rates before it be 2% again. Somewhere, a little over 4% right now. So I think there's no real serious consideration by the lion's share of the financial service industry, a whole wealth of issues that are really acute, and no consideration. And I tie it into, because I meet people still, although I don't deal with athletes anymore, but I still meet people, affluent and with lots of money, and then I meet average working day people in our planning business, and still 6 to 7 out of 10 are living at least one lifestyle above their finances. And everybody says, well, how do they do that? I said, well, just look at last week's personal income and personal spending number. Personal income was 0.3%. Consumer spending was 0.7. If you're spending $7, you're only making $3. How do you pay the difference? You borrow. And so we just continue to go down this terrible road full of landmines and just terrible conditions, with a financial community that pays little heed, that doesn't even have a plan B. I have to tell you, when I worked in sports, I had the privilege of being around the Giants for 13 years. And one thing I seen, because I was around the coaches and all, they had a game plan, but they already had a plan B. They didn't have to wait to halftime to make changes. They had a plan that if plan A didn't work, this is what we're going to do with plan B. We have no plan B, and we got a lot of people without a plan A.
And there's a huge amount of ridiculous assumptions about the stock market too. I mean, you're talking about the mainstream financial people. I mean, do watch business television. Just, it's kind of comedy at this point. A lot of it, you see the talking heads go on, and they're talking about how easily Apple or Microsoft or one of the Mag 7 will easily be able to get a multiple re-rating from 3 trillion market cap up to 4 trillion in the next 12 to 18 months. Meanwhile, like, you're paying 50 times revenues. There's a lot of ridiculous assumptions in there. I think there's assumptions, like there was a poll or something for the mainstream financial media, for mainstream money managers, and they were expecting like the S&P 500 to compound annual growth rate over 10% per year every year.
I learned a long time ago. It's what led to my early fame when I forecasted a crash and the firm wanted me to retract or resign my forecast. And it was explained to me back then that on Wall Street, you really buy or you hold. You don't use the word sell if at all possible. But I'm convinced that the Archangel Gabriel could show up at most of those talking heads' houses and tell them that God is sent personally to tell them that the market's going to crash. And they could believe it, but go down to their firm and the firm would tell them there's no way you're going on the networks to say that. Those are the same people, Jason. I know it. We can take them and throw them off the Empire State Building, and they'd all say the same thing all the way down. Hey, so far, so good.
Yeah, the chart of the 10-year Treasury is crazy. I mean, it does not look like the safest, most liquid market in the world. It looks like a meme stock, a Banana Republic emerging market debt, or a meme stock or a penny stock right now for the 6-month chart on the 10-year Treasury. The market's just, it's about to throw a temper tantrum, I think, if it doesn't get the rate cuts in the next 6 months.
Yeah, well, there is an environment now, this political environment, that's going to be the ugliest we've ever seen, and there's no question about it. There will be a tendency for the Federal Reserve to lessen any movement on the upside of rates if they were to plan that, and some pressure to actually ease it. I believe he made his so-called concession that the raising was over without actually lowering rates towards the end of last year from the political pressure from the Democratic side because Biden was just getting so beaten up in the polls and everything, and all that Bionomics talk was not getting anywhere. And so I'm always concerned about the Federal Reserve, even though they'll swear to God that they're not being influenced by it, that they will be influenced by what's happening on the political stage as much as the economy stage here in the U.S.
So we've gotten warnings in the last couple months from three bank CEOs, pretty rare, or at least I can't remember this. So Jamie Dimon has issued warnings. He sold a large chunk of his shares for the first time in his professional career. The Bank of America CEO said the full effect of all the Federal Reserve rate hikes are not priced into anything. And then recently, the CEO of Cantor Fitzgerald, an investment bank, not as big as Goldman Sachs, but still sizable, and the guy's a billionaire, he said that the losses in commercial real estate are going to be between 700 billion to a trillion over the next 2 years. So do you think that any of these asset prices are pricing in any of these warnings and the rate and the interest rates where they are?
I think it's quite interesting that some of these so-called Wall Street giants are willing to actually speak negative. Even some of them, like a Jamie Dimon, where a lot of the business at his firm is still from the sell side. Hey, Mr. and Mrs. America, it's always a good time to be in. Uh, and I think it's fair. I think it's understandable because if they're looking at what I'm looking at, uh, I can't see how you can even, I guess you would have to either be purposely blinded or not smart enough to understand all the issues that we're facing here. One thing I've said to people here for several weeks, and I think it's appropriate to say tonight, Jason, and that is, if you want to own general equities, and so for some reason, especially if you're younger, there's more time to make up if you're wrong for a period of time than seniors now who are just overweighted in general equities. Uh, Outside the US, there's much better valuations. In fact, some statistically now, some certain emerging markets have never been this much of a spread in terms of valuation compared to the US, especially when you look at the blue chips and the technology. So I wouldn't throw every equity market under the bus, but I certainly would throw the US equity market under the bus.
Were you on Wall Street during the last commercial real estate bubble with the savings and loan crisis, or when like all the commercial real estate developers, so like Sam Zell and Donald Trump, when he was a commercial real estate developer, not a politician, and Sheldon Adelson and Steve Wynn and those guys, how did the government handle that commercial real estate crisis?
Well, it was interesting that you bring about Donald Trump. People forget it, that Donald Trump was at that time, the banks just shut him off. And many people thought he had negative worth at that time, but he's always been able to talk his way out of issues, and he did. But this is different now. Uh, we don't have the friendship or the allies that would be supportive. You brought it up, I think, early in this conversation that we're not seeing foreign interests willing to buy our debt. They're walking away from it. In fact, the lion's share now is being picked up here just in America. We're seeing, as we stated earlier, this is a critical point for people to understand. Countries are forming partnerships, businesses, banks, eventually an alternative. It may not be to replace the dollar, but it'll be an alternative. And that's why they've been such major buyers of physical gold, because gold will be some part of it. And we just don't have the political strength, the military strength, whatever you want to call it, in the world. I don't want to switch subject on you, but when I tell people about mining and exploring, 20, 30 years ago, you could have took a globe out, spun it, point your finger, land on a country and say, yeah, we can go there. Can't do that anymore. A lot of places in the world, it's going to be hard, if not impossible, to operate because you're an American or because of the differences of how those people now are viewing the world and all. You just have to look at what happened in Panama with a copper company that spent $1 billion or whatever dollars, and they basically said, take a walk. And it's happening elsewhere. So I don't think America has the intangible assets that it once had to weather previous crises. So when this crisis hits and grabs hold, it won't have the outs that it had before.
So you think that there will still be bailouts, but there will be more inflation pain then? Because I honestly, I don't see a scenario where there's not bailouts. I'm speaking to bankers off the record, and they're basically just telling me there's been tons of rules changes with commercial real estate and the loans and the leases. They're playing all types of games and goalpost moving the last 12 to 18 months to delay things out, very similar to 2005, 6, 7 with residential real estate. But that this commercial real estate bubble, it's enormous and it's going to pop and it's going to be a mess.
Well, it's going to be interesting because China just had its real major real estate conglomerate basically go under today. And it was interesting to see that, and I took it because I'm very bullish on certain metals, the fact that copper actually went up in that, at least the market at the moment is perceiving it now as not as an end all, maybe a necessary evil for them to have happen. I don't think Americans yet have an understanding to the inability for us to keep financing these enormous debts. Despite markets rallying today, most Americans, their own household, a large percentage don't even have emergency savings. So when the you know what hits the fan, there's not a lot of fallback area. It's like a trap door. It's not like you can take a step back, maybe lower standards somewhat, but get by. It's just going to be madness, and that's why I have taken basically a three-step approach, Jason. My first motto is that I'm going to act less is more. I can live a higher lifestyle, but I choose not to, so I could be better off when things get tougher. Number two, I believe more in capital preservation now than capital appreciation. And three, I want to be a live chicken versus a dead duck.
And you brought up copper here. I actually just saw an interview from the CEO of Freeport McMoran, and he actually said, shockingly, Chinese copper demand grew in 2023, despite their housing bubble collapsing, because there was more demand for copper for electrical grid upgrades, electric vehicles, big data centers for artificial intelligence, people using the internet more and more electricity. So all those new types of technologies, electric vehicles, electrical grid upgrades, those things actually offset the Chinese housing bubble falling.
Yeah, and also there was an expectation, if you went back a year, 18 months ago, for 2024, the main predictors of copper prices were calling for a fairly big surplus of copper for this year. Now that's all dissipated, and some are actually calling for a shortage. And of course, once 2025 hits, it's supposed to grow more acute into the next several years. So copper certainly seen its worst period. It's managed to hold its ground for quite a period. And like I said, I think its least resistance is up. And the only thing I would say different than I might have said 6 or 12 months ago, if you and I were speaking, I don't think this electrification, sure thing, can't miss, put the pedal to the metal, so to speak, that was an attitude a couple of years ago, is the same attitude. I think people are realizing it's not as easy to say the government to all the things they want to do and actually implement them. Plus, they're having issues with some of the things that they've said they're choosing from. No one talked about a couple of years or realized, A, some of these things don't work when it gets real cold. B, the cost to replace them, and that's why Americans have still not latched on to this desire to own electrical vehicles across the board and all. And then, of course, some of the other issues that were supposed to work in this greening of the world. Wind is having a problem. Solar, some of it's having a problem. In fact, the only one that's not having a problem, and that's why the uranium price has gone up so much, is the nuclear end of it. But all in all, as I told you before we recorded, I'm all in on this bottom that I think has occurred in what has been up until now for about 18 months, if not almost 2 years, the worst period for mining, particularly the junior resource segment. I'm convinced that I didn't hear them ring a bell. I didn't realize the game was over and didn't get out in time, but instead believe I'm taking advantage of prices that are just too low not to want to put money to work there.
Yeah, I agree on your points about copper with wind and solar and a lot of those ESG investments. A lot of those companies need bailouts or have either gotten bailed out or have gone bankrupt. So the return on investment is negative. But for artificial intelligence, which a lot of the tech people are talking about nonstop, there's going to be a lot more electricity used, a lot more data centers, a lot more copper. So the amount of internet usage, electricity usage, that's going to require a lot more copper going forward.
Yeah, the only thing, Jason, is all this AI. Look what's happening to the media people and all. They're being laid off all over the place because they were one of the classic people that could be replaced by AI. So,
Well, woke culture too. I mean, like Sports Illustrated, it didn't work out when they changed their business model.
yeah, so I don't know. That's beyond my grade at this point, and I guess because of my age, I don't worry about it. People younger, but that's another issue coming down the road. But all in all, right now, where I find things incredibly undervalued, and especially when the world is still pointing to more usages of metals, and there's not a lot of oversupply of them that used to be in past years. It's much more difficult to find. You're not going to find majors willing to put $1 billion into certain countries to where social and political unrest and costs are going up. So it just seems to me, especially after how low they went last year, that it was time to just push all the chips in and take the risk that you didn't somehow you didn't buy buggy whips when the cars were first invented.
Well, Rick Roll has said recently that this is the cheapest that junior resource stocks have been in over 30 years, I think.
Well, I'd say I looked at them for 40. I don't remember even when we went under 300 at the end of the millennium in gold, uh, shares weren't written down to levels versus where with gold at 2000, they're selling like it's at, $800. And so, I'm all in on it. I'm not telling anybody else to do with that, but I rather own something like that at this point than own some of these things, the Magnificent Seven or what they want to call them these days.
That's funny because all the mainstream financial advisors, the ones on TV, a lot of the regular ones. I mean, I just got messages from a longtime friend I haven't spoken to in 10 years. He works at a bank. He's a regular banker. And he was telling me he wants to start trading QQQ and Mag 7. He wants to trade stock options on it. He's been watching classes thinking that it's the easiest money for S&P 500 and Mag 7 and the NASDAQ QQQ.
So the stock market had something this on a much smaller scale. It was the Nifty 50s in the 70 that couldn't miss. Then of course we had the internet bubble. That was the same thing. And I can remember people coming out and telling me, that they're giving up their jobs and they're going to sit at home and trade and all that type of stuff. It's when that mentality is so widespread. It's why I can't bring myself. So much money in the last few years has been lost in different types of cryptocurrencies and things of that nature. Yes, the people that were in very, very early when there was few people involved made money, but by and large, the average person lost money in it. And yet everywhere you go, people are talking about numbers. Oh, Bitcoin's going to 250,000, 500,000, 1 million. When all of that is happening, Warren Buffett had a good saying is basically when everybody's talking about it and all, it's going to be hard for you to make a lot of money in that versus when everybody's scoffing at something. Listen, gold has, since the new millennium started, has outperformed even the stock market. And people go, that's impossible. Then you show them the actual facts to that. It's the least respected investment in the world today. It's been that way for most of my career. I call it the Rodney Dangerfield of investments, relic, all that type of stuff. Yet it's worked. It's preserved purchasing power when all other currencies haven't, including the dollar. And it's now trading above 2000 for several weeks. People just say it can't be that good. Why isn't it going up more and all? And it's just something that I think offers much more safety of principle and still opportunity for capital appreciation.
And Warren Buffett and Benjamin Graham have said, be greedy when others are fearful and fearful when others are greedy. I would say that right now, a lot of people are very, very greedy for Mag 7, NASDAQ, Microsoft, Apple. I mean, I'm hearing arguments, Peter, that Apple and Microsoft are going to add another trillion of market cap from 3 trillion to 4 trillion, it's going to be easy. It's going to snap your fingers and it's going to happen.
Well, one of the things that's aiding them, I don't really, I only watch one program of financial networks early in the morning. It's the Bloomberg show. It's because of a young lady that's on there that I think is extremely intelligent. That's an anchor person. But one of the things that's aiding that is if you look out past the big blue chips, actually small caps are going in the opposite direction. So this is a much thinner, less a narrower focus stock market. And since there's still liquidity out there, we know, look, the government keeps creating these trillions of dollars out there out of thin air. That's why they're going to flow into those things. So that argument could be made that that could continue, but eventually markets can't be sustained overall when too few of the soldiers are advancing. It's an old saying a great trader used to have from years ago. He used to say, generals don't win the war, soldiers do. So when most of the soldiers aren't participating and just the generals are moving forward, that's a bad omen for the stock market.
Yeah, I agree. Same thing with the treasury bonds and the dollar rallying. I think the VIX is suppressed, it's manipulated the volatility, but there's a lot of volatility in credit and bond yields. But I'm a contrarian. I'm looking for undervalued stuff. I run valuation metrics for cash flows and stuff. A lot of these gold miners and even some of the precious metal royalty and streaming companies, the mid-tier ones or small caps, a lot of them are selling at 30% to 50% discount to net asset value. So those are like net present value future discounted cash flows. So at the current prices, at gold prices with weak energy prices, I mean, the earnings for the next couple of quarters for these gold miners, a lot of them are going to be really, really good.
I haven't seen the majors have such good free cash flow at a time when their shopping list is so much that they can purchase now has been so beaten down. And normally what they would be is they'd be highly leveraged, fighting to pay off debt. And that's not the case this time around. That's why I'm expecting a much bigger M&A period here in the metals arena. Some first among the juniors because they have to, because funding is so difficult and too many shares out, too low share prices. But we're really starting to see, in fact, the last 8 or 10 decent deals that I saw, premiums, even though the markets are down, are not 30, 40% of recent trading, but anywhere from 80 to 130%. So the majors are willing to pay up, and the reason they're ready to pay up because even when they pay up, they're still getting it at a very, very attractive price.
So they're what, trying to buy, replace reserves. They're trying to buy large deposits to build in the future.
Yeah, it just, why start now and spend the next 7 to 10 years trying to find, expand, and develop something when a bunch of companies have stuff like that that's out there and they're in the gold ground is at $8, $15, and it would cost probably anywhere between $60 to $100 an ounce eventually to get up if they had to find it on their own. So that's why I think there's going to be a very big mark increase in acquisitions of not grassroots, but legitimate companies that have identified resources, but for one reason or another, because they were in a market where everybody got green, the baby got thrown out with the bathwater, their gold is being priced in the ground far less than the $50 or $60 that it should be at this point in time.
Yeah, I agree with you. I think there's going to be mergers and acquisitions because I think the main point here, even though gold prices in dollars are over 2000, it's a bear market for a lot of these companies. The capital is really not available. So unless you're a Newmont Mining and you have a cheaper cost of capital, maybe a Franco-Nevada, although Franco's not being aggressive lately, the majority of other gold companies, they can't go out and either borrow a bunch of debt or raise equity capital in this environment. So there's not a lot of capital available for them.
Yeah, and that's why mergers and bigger is better will be the attitude. And it's already begun. I've limited my focus to North America. And in certain places like Arizona and Nevada, which are prime places to look, and in Canada, Ontario, and Quebec, and Newfoundland, very favorable places for mining. I think we're going to see lots of M&A there.
Do you expect gold demand from the non-G7 central banks and the private sector like China, India, Turkey? Do you expect that to keep increasing going forward?
It has. And you know what's interesting? The I joked, I put it up today. It's amazing sometimes, usually between the hours of 10 and 11 a.m., gold tends to trade down on the COMEX, I call it, and I'm not the only one. I call it the CRIMEX. And but what's interesting is even when we have these raids, and we've had days where it's been knocked 30 or $40, 10 years ago, that would take weeks or months to recover. Now it recovers in hours or a few days maximum. And the reason is more and more of the demand and where it's physically trading is taking place in Asia now and away from London and New York, where these, call them cartels, call them whatever you want, but groups that were more profitable playing the downside to gold than upside. And so the paper market, while still influencing the gold price, is slowly being overcome by the physical market. That's why there's such premiums in Asia compared to here. And the more trading that goes there, the less and less influence London and the United States is coming. And that only bodes well. But I'll just say this much, Jason. If you could tell me, Pete, I saw the future, and for 5 days we traded at 2100 or above, I'll tell you the game in gold will change dramatically because we'll be above every past peak where everybody points, oh, look, it's a triple top, it's a quadruple top. We'll be in brand new area. We'll get all sorts of momentum players in it. And then technically, because of how it previously traded out of these source cup and handle formations and things of that nature, we'll see a couple $100 come into the market on the upside pretty fast, I think, in a matter of weeks or a few months. So I'm quite optimistic. I think there's $100 risk to the downside and at least 5 times that reward potential to the upside.
We're going to need substantially higher gold prices so the juniors can raise capital to bring new mines online. I mean, the current pace for new mines coming online, it's not going to offset the depletion from the large gold miners, gold and copper miners, their mines depleting. So it's going to be difficult to bring online a lot of new gold mines at the current gold price with the lack of capital available. There's not a lot of incentive.
So speaking with you is like speaking to myself. That's what convinced me to go all in. That just the argument has just become overwhelmingly bullish for the buy side, and it needs something to crack it, and that crack will come. It'll probably come from something that happens fundamentally to drive gold up through the 2100. Something happens, either like they said, they suddenly drop rates a lot, and that causes something happens in the Middle East far worse than now, and all something on the political front. And once that happens, it's just going to be almost like an overnight sensation.
Well, I'm just arguing on the supply side for cost of capital and the cost of mining and the grades. I mean, 5-10 years from now, the costs for mining are going to be up a lot. The grades keep falling. I mean, I don't know if you've ever looked at the grades for
Oh yeah.
Panama. Hmm?
Oh yeah. Jason, everything you're saying is and more. And I'm not trying to stop you from saying it, but it is. But what's happened is we've had this building up for a year or two, and people that heard this argument and heard it from me and others and went in, they saw their shares down 50% from where they bought them. And so there's just something wrong to them. And then, like you said, their friend tells them about how much he's kicking it in an apple or something of that nature. But this supply and demand scenario cannot continue endlessly like this. It's going to flip. It's going to be like a flip of a switch. And unfortunately, if you wait until the flip a switch, then what happens is they pop up. You say, oh, let me just wait for a pullback, and you never get enough of a pullback. So you have to buy here and hold maybe longer, but it goes back to another philosophy that I learned that separate winners from losers, and that is it's much better to be a lot too early than a day too late.
Well, look at uranium in 2020 and 2021. I was writing articles about Cameco and uranium stocks back then. No one wanted to hear any good news, anything that like these stocks are cheap. There's good upside there. There's going to be more nuclear power plants. The cost for uranium production. No one wanted to hear any bullish argument back then.
Well, I did, and that's what kept me afloat for making up for some of these losses in the general junior market, because I got very involved. But today I even said that it was time to take Cameco, which many people I know bought at 8, 9, 10, maybe 15. And I said, listen, it's still a good company. It's still likely to go higher. but the leverage now and upside potentials in these juniors now, they have 5 to 10 to 20 time return possibilities. Chemical maybe has a one time, could double from here over the next 3 to 5 years, maybe. So I decided to shift. Now, of course, that comes at a time when many people bullish. I still think the uranium price is going higher, but it's not cheap anymore, and it suddenly became overly bullish. Everywhere you turned, people were being very, very bullish on it. And I'm never comfortable when a boat is crowded. I'm never comfortable in crowds. So right now, very few people want to talk about juniors. The people that do it professionally, and I'm not speaking to you, but that are out there, newsletter writers and other types that have these social media platforms and all, they talk like and just hope people forget what they said the last year or two. But as bad as the last year or two has been, I'm very optimistic that the next year or two is going to make up for it, more than make up for it.
It'll be very interesting. I mean, at the current metals prices, it's not a bull market, and the cost of capital. I mean, I was hearing stories from the Denver Gold Forum back in September. There was almost no generalist people there. I mean, there was no interest in juniors. It was almost empty. I was seeing pictures from the Denver Gold Forum. There was almost no investors that were from general funds that were there, and the ones that were there only wanted to buy royalty companies that had free cash flow.
Oh, I understand that. Like I said, Jason, in that part, you're singing to the choir.
Well, the cycle will turn. I mean, that's the thing about commodities, right? So the cure for low prices is low prices. As Rick Roll says, cure for high prices is high prices. So eventually the cycle will turn. I mean, timing is the most difficult part of it, I guess.
Well, there was a great newsletter writer. I think you remember him, James Dines, and he had a great line. He had a lot of great lines. He says, timing is everything. Think of the poor guy that invented preparation G.
I know he was a uranium bull. He didn't get to see this big pop, though. I think he died a
No,
couple years
no,
ago.
but he was one of the more enjoyable people to listen to speak. He was very, very colorful and quite good at times.
Well, I really enjoyed our discussion today, Peter. Let's have you on again in a couple months. I think we're going to see a couple months from now, we're going to see those earnings and the free cash flow from some of the larger senior companies. If they have free cash flow, they're going to buy back shares, they're going to raise dividends, and then they're going to go do what you said. They're going to go do acquisitions. So if the valuations are this cheap and the company's earnings, free cash flow are good, they see those assets cheap, they're going to go buy them soon.
From your mouth to God's ears, Jason.
If my listeners want to follow you, I know you have a YouTube channel now and you're a little active on Twitter. How do they do so?
Sure. There is a website, petergrandich.com. There's a blog there. There's also a YouTube channel, but much of my commentary now is on my Twitter page. And of course, you can find me under Peter at Peter Grandich.